Ladies and gentlemen, good morning. Welcome to the third quarter 2021 results presentation. The conference must not be recorded for publication or broadcast. You can register for questions at any time by pressing star and one on your telephone. Should you need operator assistance, please press star and zero. At this time, it's my pleasure to hand over to Mr. Martin Osinga, UBS Investor Relations. Please go ahead, sir.
Thank you. Good morning. Welcome, everyone. First, I want to draw your attention to our cautionary statement slide at the back of today's presentation. Please also refer to the risk factors in our 2020 annual report, together with additional disclosures in our SEC filings. Moving to slide 2, our agenda for today, and it's now my pleasure to hand over to Ralph Hamers, Group CEO.
Hey, thank you, Martin. And everybody on the line, welcome. Thanks for joining us this morning. Hey, it's a good quarter, you will see. We're fueling growth today, but also for tomorrow. Across the board, our clients are benefiting from our trusted advice, quality execution, and our growing ecosystem. Our strategic initiatives are working, and our investments are paying off. So for the quarter, we delivered a 2.3 billion in net profit, the highest in almost 15 years, and our return on CET1 capital was over 20%. So we're making good progress on our strategic refresh as well, and we'll give you an update on this shortly in this presentation. Turning to the next slide, just looking across, you see the market and economic backdrop were broadly positive in the third quarter. Although there was some recent uncertainty towards the end of the third quarter, equity markets are still near all-time highs. Vaccination rates are rising. Fiscal and monetary policies remain supportive. But at the same time, we see fears of inflation, the spreading of COVID variants, policy uncertainty in China, the US and also in the US, raising concerns around economic growth. We hear similar concerns from our clients too, of course, as evidenced in our last sentiment report. But whatever the environment, we'll continue to provide our clients with our valuable advice and quality execution for them to weather through these uncertainties. So if you look at this slide, you see the ongoing momentum with the clients. Our private wealth clients continue to turn to us for these solutions, for the advice. At 5% annualized growth, we saw another strong quarter of net new generating fees, net new fee generating assets. Man, what a word. And as FGA, adding to the scale of our global ecosystem for investing. Net new loans were positive at $3.3 billion, driven by the Americas. That was despite the volatility in Asia Pacific causing some deleveraging in the region. We're helping our clients navigate volatility and capturing opportunities. Transaction-based revenues with private wealth clients were up 4% year on year against what was already a very strong performance last year. We saw particular interest in alternative investments and structured products as investors look for investments with a positive real yield that are resilient in a higher inflationary world. We saw $1.5 billion of inflows in asset management in the quarter, with continued strong momentum in alternatives, ETFs, SMAs as well. And from my first meetings with other CEOs, you see that the optimism is obvious. We're seeing corporate clients looking at actively pursuing M&A opportunities, and that is delivering some growth and fueling some growth as well. They want to do it in order to fast forward the growth themselves, build skill themselves, and preempt disruption as they see it in their markets. At the same time, private equity funds are flush with capital. That is still affordable, and that all adds to the M&A activity that we see. Funding markets are also favorable. We're helping firms take advantage of this as well. And as a result, the advisory and the equity and debt underwriting all had their best quarter on record. The best third quarter on record, I should say. Global banking revenues were up 22% against last year. SPAC-related fees were 43% year over year, mainly from deferred fees as mergers closed. In markets, our strategic choices are paying off as well, with $1.4 billion in revenues. Equities just had its best quarter on record as well, third quarter on record as well. We saw particular strength in Asia Pacific cash equities, and we're pleased with our performance in global electronic FX, both areas of focus for us. Prime brokerage balances reached an all-time high, helped by several hedge fund launches in the year. And in Switzerland, we see a continuing trend among our clients in converting cash savings into investments as well. Net new investment products were 700 million Swiss francs in the quarter, 13% growth annualized, driving record recurring fees there as well. Now, continuing to build and deliver on our ecosystem for investing is fueling our growth, as shown on the next slide. Just to start with the private markets here, investors continue to turn to private markets as a source for diversification, as you can well understand, but also for yield. We expect this to continue, even if markets were to turn a bit more volatile here. It's an asset class where our clients are generally underweight, and therefore an area where we can add value. During the first 9 months of the year, we facilitated 26 billion of investments into the private markets and institutional investors as well. Our integrated SMA offering in the US saw another 5 billion of inflows this quarter, demonstrating what we can achieve by working seamlessly together for our clients. And yet another good example of our ecosystem at work here. Sustainability is not only the right thing to do, it's become a major engine for us for growth. But we also know that sustainability has many facets. That's why last quarter we further expanded our sustainable investment offering. For example, our private wealth clients can now personalize their sustainable investing mandates along 6 topics, depending on their preferences. We also became the exclusive distribution partner for Robeco's Global SDG Engagement Equities Fund, and that's a fund that motivates companies to fulfill UN SDGs, and we target to raise 1.5 billion of investments over the next 6 months for them. Sustainability focus and impact investments grew annualized by 63% year to date and reached $207 billion for us. Now, the success of My Way, as you can see here as well, continues as well. My Way is an intuitive application that allows clients and advisors to jointly set up, monitor, and adjust mandates. Continued, and the inflow continued also this quarter. Invested assets on the platform more than tripled year to date to around 5.1 billion, as you can see, adding to the strong growth we see in mandates globally. And lastly, the third quarter again highlights the scalability of our platform. Year to date, we more than tripled net new fee generating assets per advisor, and this scalability is a significant contributor to the strong operating leverage this year. So the financial results overview shows you that our business momentum, our focus on fueling growth, our focus on disciplined execution for our clients, delivering the full ecosystem to our clients, basically, the capabilities that we have ourselves, but also the capabilities that third parties provide through us. All of this led to another strong quarter across all of our businesses, but also all of our regions. And that resulted in a pre-tax profit of 2.9 billion. You can see an overview of all of this here across the different dimensions. Operating income, for example, was at 9.1 billion. That was up 2% from last year when we had a number of one-off gains. So in terms of the underlying, this is much higher quality in terms of income than it was before. Operating leverage strong again because the costs were actually down 1% year over year. Here you see the mix of how we've reported as well as the how we've already kind of executed on some of the savings plans coming through, and more to come next year to support our investments. And all of this resulted into a cost income ratio below 69%, the lowest in over a decade. Net profit up 9% to the highest level in over a decade as well. return on CET1 capital reached 20.8%. Tangible book value per share was up 4% sequentially here as well. As you can see, we continue to perform well above the financial targets that we have given you. And while we do that, we continue to be focused on driving growth on the top and the bottom line. Now, before I hand over to Kurt, because this is where I basically do that normally, I'd like to give you a bit of an update as to where we are on our strategic refresh. As I told you in the first earnings call, I would do a couple of things in my first year, which is one is concentrate on the business momentum, and the other one was to look at the strength of UBS. And there is many things that have impressed me, that I'm impressed with at UBS. So when I took over as a CEO a year ago, I was excited to build on this foundation and to make a strong organization even stronger. And I saw so much potential beyond what we were delivering on, and that it was all about unlocking the true potential of UBS. And as I said, there's these three priorities that I focused on the first year. The first one is to articulate that purpose that was always there, but was always implicit and never explicit. And we made that very explicit now with reimagining the power of investing and connecting people for a better world, which is really a driver for consistency across what we do, a driver and a support for dilemmas that we run into, also in terms of making strategic choices even. Second priority for me was, of course, safeguarding people and clients and supporting clients through the pandemic, which I think, hopefully we're completely through, but nobody knows. Introducing a hybrid approach to working going forward as well. And third, just make sure that, our clients are really supported and navigated in these markets that are not always as clear. And that's what we performed on, and you've seen the results. As to the strategic plans, I've also said that I would give you updates during the year when we felt that there was an update to be given, but that we would give you a full strategic update towards the end of this year, of this financial year. So we will give you a full strategic update on the 1st of February. And today I will show you a bit on Switzerland, the Americas, and technology. So first things first, which is Switzerland. Switzerland is of course a very important business for us, and it's important that we continue to be the number one universal bank as we are. It's a highly integrative business. It's serving around 1/3 of the households here in Switzerland. It's serving over 90% of large corporates in our home country, and we enjoy a leading position in about every segment you can think. The successful execution of our strategy has led to growth, made us more efficient in how we serve our clients, and that helped us to offset some of the impact from the negative rates that we've seen here for almost 6 years now. So in addition to being stable and resilient, Switzerland is also our biggest region in terms of profit, with 2.5 billion in profit before tax during the first 9 months of the year, and that's 37% higher than last year. And that makes it a very good base to take the next leap forward. Which brings me to our key priorities for personal and corporate banking on slide 9. First, we aim to grow, and more than that, we aim to grow faster than the market. This means that we will double down on our commitments to be the number one universal bank in Switzerland. We make sure that we're the undisputed number one universal bank in Switzerland, making sure that we become even better for our clients in areas such as private pensions, sustainable finance, and mortgages. That's where we see growth opportunities. It will not come as a surprise that our digital capability will play an important role to make this happen as well. And that's why you see that the second and the third priorities for Switzerland are both technology dependent and technology focused. With digital at the core, we want to make sure that we remain the digital leader in Switzerland as well. We're focusing on making all of our banking products, our basic banking products, available digitally. That's an absolute must. We will invest in that, making sure that all of our basic banking products become digitally available and backed up with remote advice to the extent needed. We are improving the experience for our clients through that as well, and we're doing that. And of course, we're not waiting for a launch of a strategy. We improve as we go, and we have already some handsome results there. And also make sure that we get some extra efficiency from this as well. And these efficiency gains, then we can invest in growing above market, as I said. In order to be successful in all of that, we have to further transform, and our transformation objective is about our people. It's about our culture. We have to organize our teams around client needs. We have to become faster. We have to become simpler and more relevant for our clients as well. And under this priority, our Swiss business is leading the way with regards to the Agile at UBS setup. And we're rolling this out through the rest of the organization. We've also reduced up to 2 management layers in P&C in the Swiss business, in the P&C part of the Swiss business already, in order to become less hierarchical and make sure that people basically use the strength they have in making things work for our clients and speed up decision making. With these initiatives, we target to grow our revenues with investments funded through our cost saves, through the digital at the core. We will have cost saves, and part of those saves we will invest in those products that I just indicated, growing faster in pension, sustainability, and mortgages. And if we do that well, we will really make a shift away from the cost-income ratio of around 60% to a cost-income ratio of around 55%. By 2025. That's what the plan is supposed to do, and I'm confident in the team to deliver upon that. So here, even with a leading position, we do think there is further improvement potential. We do think there is further growth potential, and we want to maintain our number 1 position in our home market to be the better bank for our customers. Turning to another region of importance, as I said, in March, there's in terms of geographic focus, there's 2 areas that are of utmost importance for us, because that's where the wealth pool is growing faster than anywhere else, and that's also where the wealth pool is larger than anywhere else. And one of those regions is the Americas. It's important for us to be active in the Americas. It is an important part of our investment ecosystem. We have a focused and client-centric strategy that plays to our strengths as a global bank here. That differentiates us also from the other players in the marketplace. We've consistently invested in our business and our people for the benefit of our clients. We anticipated trends, we anticipated changes here, and you see that is paying off. We're well regarded by our clients for our thought leadership, for our solutions that help them achieve their liquidity, their longevity, and legacy goals as well. And as a result, we're growing our ecosystem. Net new fee-generating assets were 12 billion. We're up 12 billion. That's 7% annualized in the first 9 months of the year. Net new loans were equally impressive at an annualized 28% year to date, just in this region. Our partnership with Banco do Brasil has added to our growth as well. Year to date, we executed 127 global banking deals through this JV, which is developing to a valuable feeder to our ecosystem. Profits in the region grew by 19% year on year to 2.1 billion. Prospects for the markets are also very attractive. The US, as I said, is the largest wealth pool globally, and it's also expected to grow faster than any other mature market. But it's also a dynamic market. In the next 10 years, 70 trillion in assets are forecasted to transfer to the next generation. So a lot to gain here if you are well positioned to it and to advise your clients. And that is what we are, and that is what we want to be with some additional actions. And that gets us to the strategic priorities in the Americas on slide 11. In order to capture these trends and grow our franchise in the Americas, first of all, we still see ample opportunity in our core business, building on the momentum that we currently have with our clients. So what we think we can do even better is to deliver and grow our ecosystem across all of our businesses, the investment banking capabilities, the asset management capabilities to support our wealth clients. And to the extent we don't have capabilities in-house, as I said, our ecosystem is an open ecosystem. We will look for capabilities that third parties can help us providing as well in order to truly deliver to our clients what they need and to give them, to generate the best client outcomes on this one. And we have the scale for that, and we will build on that scale. We have the content for that. We have the solution for that. And through that, we are confident that we can continue to drive growth in the coming years. In order to do that, we will also continue to enhance our platforms from which our financial advisors work in wealth management. As I said, that's a running program, and that is progressing. But in order to support our financial advisors and our clients even more so, we have a second priority, and the second priority is about being a more holistic bank for our clients. We're planning an upgrade to our banking capabilities to deliver a full-service banking offering. As you know, many of our clients there are business owners, so the offering will primarily cater for them in terms of lending and cash management as well. We have a very well-functioning bank there with high net promoter scores for our clients, and we think we can build on to the experience that we have there and just give more services to our clients, and with that also be even more relevant to our clients through the whole life cycle. Of course, that these capabilities will be digitally led. They will be based on cutting-edge technology. And as I said, they will be aligned with our client promise, which is these services need to be personalized, they have to be relevant, on time, and seamless. Now, our third priority for the Americas, and specifically for the US, is the rollout of a digital-led service proposition, and that's a scalable investment advice model for affluent clients. We are a trusted brand in the US, and we have premium content. And we see the opportunity to deliver our expertise and our content to a much broader set of clients. And we will start with our workplace wealth clients and our platform there. And we already service 2 million stock and retirement plan participants there. We're planning a differentiating offering, combining a winning digital experience with trusted human advice on a remote basis. And I think that's another example of how we can actually go back to our DNA of content and knowledge on one side, of advice on the other side, but delivering it in a digital, scalable way to clients we already have that already think UBS, that have business with UBS, but want to do more of their wealth management with UBS, and that's an affluent proposition. So we're looking at increasing the share of wallet with our clients and bringing the ecosystem to our clients. We're looking at further improving the growth with our clients and profitability with our clients, delivering more banking products. And we actually think we can grow in the market by addressing a further client segment, the affluent client segment, by building a digitally led but remote advice proposition to the new clients in the market. All of that brings us to where we are on technology. And also here and also in the previous plans, I mean, we're updating you on these plans, but it doesn't mean that we have not already kind of made steps in this direction, and some of the results that you see today are already because of some of the steps that we've made. But specifically also on technology, the execution of our strategy to level up technology, to make technology a differentiator, that's truly in full swing. There is no plan developed at this moment in time in UBS where technology is not taken into account from the first instance, which basically means how do we deal with our clients? How do we service our clients? It is there where technology can make the difference. It is there where technology can bring the personalization. It's there where technology can bring the relevance of the content and making sure that when we have a proposition, it will be there on time. So that way of thinking is prominent now in every plan development, and it's important as well. But for that, you need good technology itself. You need an engineering culture as well. You need to manage technology in a very frequent way. And that is what these 5 pillars try to tell you. So if you want to be successful at technology and you want to deliver technology, you have to work agile front to back. So we have launched Agile at UBS and are in the process currently of transitioning some 9,000 colleagues into this cross-functional setup. At this moment, 3,000 of them are already working in agile ways today. We are piloting it in different areas as we speak. And the experience on the back of these pilots, we will then use to roll it out even further. And in the end, we do expect that towards the end of next year, some 25,000 people will actually work in Agile at UBS. In order to support that, because if you work Agile, you deliver incremental improvements in technology in 2-week sprints, as you know, but you can't do that in the back of annual planning, so you do quarterly planning. So we've made our planning cycles shorter already. We've made them faster. We've made them more frequent. So we have started to our quarterly business reviews, looking 3 months back as to where some of these projects have delivered, where some of these projects are going the next 6 months, what we need to change, what we need to optimize, what we need to prioritize, but always with the strategy in mind, not tactically, strategy in mind. So zoom out, strategy, zoom in, 3 months back, 6 months forward. That's the way we run it. But there is more that we can do here, and that is all around data and analytics. We feel they are critical to meeting our client promise in these days. And that's why, and maybe you've picked up on it or not, but recently we've implemented a central hub to drive the AI data and analytics approach and strategy in the group. In the same vein, we rolled out a new AI-based recommendation engine for clients' advisors in Switzerland already. And lastly, on this chapter is, to make our technology estate even more flexible and less expensive to maintain. We're migrating away from legacy technology. We've already decommissioned hundreds of applications. We're moving 1,000 applications to the cloud just this year. And as you can see, we're putting the foundations in place to turn technology into a differentiator here at UBS as well. Now, where are we on our journey here? And I think I'm proud to see what's happening here at UBS, the momentum that we have been able to build over the last couple of quarters, at the same time defining our future without taking our eyes off the ball. Here you see some of these results. Clients are rewarding us for what we do for them. That's why we get their business. But that business also delivers attractive returns to our shareholders. And you see that on this slide. Our financial performance this year shown to you in a more historical context. The last 9 months we had the highest operating income in over a decade, the highest pre- and post-tax profit in over a decade, the lowest cost-income ratio in over a decade, and a nearly 20% return on CET1 capital. I think this is exactly where I have to hand over to Kurt.
Thank you, Ralph. Good morning, everyone. At 2.3 billion, we delivered the highest net quarterly profit since 2007. This translates into a 20.8% return on CET1 capital and a 17.2% return on tangible equity, and drove 2.8 billion of CET1 capital generation. PBT of 2.9 billion was up 11%, driven by 2 percentage points of operating leverage. The cost-to-income ratio improved 2 percentage points to 68.7%. As a reminder, our third quarter last year included a 631 million gain from the partial sale of Fondcenter. Excluding this gain, all business divisions and regions contributed to PBT growth and efficiency improvements. Our 3Q results included net credit loss releases of 14 million, of which 11 million in stage 1 and 2. While some macro factors have improved slightly, we once again decided to apply a management overlay given continued macroeconomic uncertainty. As of September, the total overlay was 219 million, a 36 million increase from 2Q. Year to date, we generated 6.1 billion in CET1 capital, including about 500 million from the amortization of deferred tax assets in the U.S. Given the ongoing tax discussions in Washington, we wanted to update our sensitivity guidance in relation to our tax loss DTAs. Assuming no other changes, we would expect that the value of our U.S. DTAs would increase by approximately 300 million for each percentage point increase in the U.S. federal corporate income tax rate. This would be effective in the quarter in which the tax law is enacted. Turning to expenses, year to date, while growing operating income, we were able to maintain operating expenses, excluding variable and FA compensation, currency effects, restructuring, and litigation, broadly stable. This helped us deliver a 9-month cost-to-income ratio of 71.4%, our lowest since 2006. As a reminder, for the fourth quarter, we expect an increase in costs due to seasonal effects, as we have seen in prior years. Moving to our businesses. GWM PBT was up 43% to 1.5 billion, its best pre-tax profit on record. All regions contributed with double-digit profit growth, another record quarter in the Americas, and the highest 3Q profit in APAC. Operating income growth outpaced expenses by 9 percentage points, with improvements across all revenue lines and a gain of 100 million from the sale of our domestic business in Austria, driving the cost-to-income ratio down 6 percentage points to below 70%. This was our 9th consecutive quarter with year-on-year positive operating leverage, and our cost-to-income ratio in the Americas fell below 80% for the first time. Net new lending was 3 billion, mainly on continued strong momentum in the Americas. This was partly offset by some deleveraging in APAC as client sentiment became more cautious following recent policy developments in China. Year to date, GWM generated net new loans of 21 billion, or 13% annualized growth, almost entirely from Lombard and mortgages. Our net new fee-generating assets were 19 billion, an annualized growth rate of 5%. Our annualized net new fee-generating asset growth rate for the first 9 months of this year is 8%. Moving to income. Recurring fees grew 23% to a new high, driven by market performance and continued strong net new fee-generating assets. Net interest income was up 8% sequentially on higher deposit volumes and fees, along with continued increases in our lending NII. For the fourth quarter, absent any interest rate headwinds, we expect NII to remain broadly flat compared with the third quarter. Transaction-based income rose 4%, driven by higher client engagement in alternatives, life insurance, and structured products. While client sentiment remained more muted in APAC due to uncertainties around China, our continued focus on book transformation and positive flows over the past quarters allowed the region to deliver its best 3Q PBT on record, as I just mentioned. Our interactions with clients in our world-class investment solutions, together with a constructive market backdrop, drove net investments of $98 billion in fee-generating asset products over the last 4 quarters. Net new fee-generating asset growth was above 6% in all regions, with 15% growth in Asia, as we are seeing increasing interest by clients to diversify globally and move into endowment-style investing, private equity, and private credit, as well as hedge funds. We saw very strong momentum in P&C, driving our PBT up 44% to 439 million Swiss francs. Operating income increased 18%, with recurring net interest and transaction income all up year on year. Credit loss releases in the quarter were 6 million, a 91 million year-on-year improvement. Cost-to-income ratio in the quarter was 57%. Transaction-based income increased 7% on higher revenues from credit card and foreign exchange transactions, reflecting an increase in travel and leisure spending by clients as pandemic restrictions continue to ease. Recurring net fee income was up 18% to an all-time high, primarily on higher custody, mandate, and fund fees. Continued momentum in recurring fees was helped by 700 million of net new investment product inflows, as we engage with clients to provide alternatives to cash deposits. Year to date, net new investment product flows were 2.4 billion. Net interest income increased by 5% year on year as a result of various deposit optimization measures, which led to lower liquidity and funding costs and was further helped by 2.1 billion of net new loans in personal banking year to date. For asset management, I will reference year-on-year comparisons excluding the $571 million gain on sale in 3Q20. PBT was up 27%, the 10th consecutive quarter of year-on-year PBT growth. Operating leverage was positive 11%, driving the cost-to-income ratio down 7 percentage points to 64%. Excluding a 28 million loss related to an associate, net management fees were up 16% on market performance and nearly 150 million net new run rate fees over the last 12 months. Performance fees decreased to a more normalized level of 33 million. For the next quarter, we would not expect performance fees to repeat the exceptional result we saw in 4Q last year. After 6 quarters of exceptional net new money growth, where we averaged 20 billion, excluding money markets, net inflows were muted in 3Q at 1 billion. The IB delivered its best PBT since 1Q13, up 32% year on year to 837 million. The return on attributed equity was 26%. Since the beginning of 2020, our investment bank has been delivering outstanding results, supported by constructive markets and while remaining disciplined in deploying balance sheet. Revenues have been above 2 billion every single quarter, with average return on attributed equity of 20%. We delivered this performance while absorbing regulatory RWA increases and remaining within our up to 1/3 of group RWA and LRD. This quarter, global banking revenues were 22%, with the highest advisory, ECM, and DCM 3Q revenues since 2013. Advisory was up 78%, benefiting from a higher number of sizable M&A deals, Equity capital markets increased by 32%, driven by higher levels of ECM issuance led by IPOs. Debt capital markets rose 7% on higher levels of leverage loan and bond issuance. Excluding a $215 million gain from the sale of intellectual property rights associated with an index family in 3Q20, global markets revenue increased by 5%, driven by equity derivatives, cash equities, and prime brokerage. These were partly offset by lower income from rates, foreign exchange, and credit products against a strong year-on-year comparative. Excluding $229 million accelerated expenses from the modification of certain outstanding deferred compensation awards in 3Q20, operating expenses were up 3%, mainly on currency effects. Cost-to-income ratio was 67%. During the quarter, we generated $2.8 billion in CET1 capital and increased our CET1 ratio to 14.9% and our CET1 leverage ratio to 4.31%. RWA increased by $9 billion sequentially, mostly driven by regulatory add-ons, which we detail on page 42 of our third quarter report. As guided, we completed $600 million of buybacks in 3Q, increasing our year-to-date repurchases to $2 billion. In the fourth quarter, we expect to repurchase up to $600 million. With that, we can open up for questions.
We will now begin the question and answer session for analysts and investors. Participants are requested to use only handsets while asking a question. Anyone who has a question may press star and one at this time. The first question is from Flora Bocahut from Jefferies. Please go ahead.
Yes, good morning. I have two questions, please. The first one is regarding the NII sensitivity. I see in your report that you mentioned the interest rate sensitivity is $1.6 billion of additional NII for 100 basis point parallel move up in the yield curve. Can you maybe quantify how much of that would be specifically US driven, and also what would be the time frame for that 1.6 billion, whether it's over 12 months or longer? So basically any comment you can make, to help us understand the drivers on the NII sensitivity would be helpful. The second question is on the level of profitability, which is obviously very much above your target and has been for a few quarters now. The return on common equity Tier 1 was 17% last year. It's almost 20% in the first 9 months. This is on the level of capital that has piled up. Part of this performance is cyclical, but when you look at the drivers of this higher profitability, I just wanted to ask you which ones do you think are sustainable and set to continue? Thank you.
Yeah, thank you, Flora. Just in terms of the net interest income generation, first of all, the 1.6 billion is for a 12-month period. Clearly, just given the concentration of our deposits in U.S. dollars overall, there would be a fair portion of that in the U.S., but we don't provide details exactly on which market and which currencies that would show up in. In terms of our level of profitability overall, I think clearly as you look at the overall shape of our operating income and our performance, we are very levered in equity markets. And to the extent that equity markets actually hold up, that's very constructive for our profit levels. And to the extent that we see good volatility in equity markets, it's very helpful to our markets revenue and our transaction revenues. Now, clearly going forward, we can't control market factors. What we can control is the overall flow levels that we generate in the business and also the broader activity around the ecosystem that we continue to look to build out. And there we're confident that we're going to continue to see very good flows going forward, and we're also going to continue to see enhancements across our ecosystem-related investments that will generate collaborative and other revenues and help scale the business.
Yeah, maybe so on that one, clearly it's a mix of capital discipline. So, it's a capital light model that we will continue to work on. And it's the scalability and the cost discipline on the other side. Income is one that clearly, through client advice and market support, etc., will always be partially ours and partially not ours. What we can control is capital discipline and cost and scale discipline.
Thank you.
The next question is from Nicolas Payen from Kepler Cheuvreux. Please go ahead.
Yes, good morning. I have two questions, please. The first one is on technology, where you speak about transitioning to agile with more than you target 9,000 people transition to agile. So I wanted to know what does it mean for UBS in terms of operational performance and perhaps even in terms of financial performance. And the second question is on costs. Your target is to be between 75 and 78%, and you achieve 69% cost income ratio on this quarter. So I wanted to know what kind of performance do you think is sustainable going forward? Thank you.
Yes, thank you, Nicola. So on the first one, on the agile at UBS, so what we're introducing here is front to back agile. So this is not agile on the technology side, and then you have a completely different rhythm in the rest of the organization. No, this is front to back agile, which basically means that people who know the customer interface, the people who know the products, the processes, people who are actually into engineering, you basically put them into multidisciplinary teams, and you run them in two-week sprints towards an outcome. And if the outcome is satisfactory, you go for another sprint, and if not, you either kind of fix it, or at a certain moment you may even stop the project, right? So that's one. In order to make this work, you take out layers in order to be less hierarchical and make sure that people who are there, that they actually become also contributors rather than just hierarchical managers. So that's a big change there. And with that, what you're trying to improve, and what my experience is that you improve, is time to market, fail fast, and much higher productivity for the same IT investment that you do. So you'll see that in the plans that we have, we more or less work with the same technology budget, but we feel we can get much more out of this technology budget in terms of outcome by working agile and by improving the engineering culture and the quality further on of the engineers as well. So the productivity gains and the time to market, that will all lead either to doing more for the same buck or for better commercial success, and that's what you will see. And that gets me to your second question, which is your cost income question. We're very happy that we have kind of broken through the 70% ceiling here, and or floor, I guess it is, from where we come. And so we're happy that we have accomplished that this quarter. To the extent we feel there is a moment to update the financial KPIs around where we think we can run UBS structurally, we will come back with new targets on February the 1st when we update the market around new targets.
Thank you very much.
The next question is from Kian Abouhossein from JP Morgan. Please go ahead.
Yeah, thanks for taking my questions. First question is regarding Asia, and if you can talk a bit more about the lending net loan reduction and net fee generating asset reduction, and also what you're seeing going forward. Should we think about a lower net new number in terms of growth, considering the situation in China, and what is the outlook for 22, so to say, around net new money in that region? The second question is regarding your valuation, really. If I look at your valuation against Morgan Stanley, which has a similar mix, clearly more US focused, you traded a 30% discount, and at times even 40% discount. And I'm just trying to understand how you think about your valuation against some of the peers which have a similar mix. How do you explain in your own view that material discount?
So, Keen, the second question is a very difficult one to answer, right? So this is the market, and maybe you should actually answer that question for us. The only thing what we can do is and what you've heard today and what you will hear more of in 3 months' time is that we know what the power of UBS is, and we know how to orchestrate the ecosystem of capabilities that we have in-house or that we can orchestrate with third-party providers in order to service our clients best. That's what we do. That's what we work on a daily basis, and we feel that potential of UBS working across the more divisional structures, if you will, but to be much more client-focused, that is what can bring out the best of UBS and the potential of UBS. And you will see many of our plans geared towards that. And that is how I am confident that our valuation will further improve. Any comparison to any peer who has a completely different constellation of income and strongholds and home markets is a difficult one to make. We do what we think is best to bring the best of UBS to our clients, and with that, we do think there is quite some potential here. So that's my point there. Then on Asia, now clearly, on the back of some of the bit of more of the uncertainty towards the end of the quarter, we already saw that coming, and we have asked some clients to deleverage, and with deleveraging also comes the sale of assets, clearly, and the repayment of facilities, and that's what you see coming through on NNL and NNFTA. We actually believe that maybe there's some uncertainty to come, and that may impact maybe a bit. But I think the way we look at Asia is much more strategic. We've been there for the last 60 years. We know that the wealth pool is large, that it will grow faster than anywhere else. And therefore, we are committed to the region. We will invest in the region. We are investing in the region. We are hiring in the region. And therefore, we think that will bring the numbers back up. Maybe, Kurt, if you have anything to add.
No, I think you captured it. I would just note that we've seen a number of other cycles, and I would just highlight the fact that I think Asia always covers faster than expectations, and so I think we'll continue to see that going forward.
Thank you.
The next question is from Andrew Coombs from Citi. Please go ahead.
Thank you. Perhaps one follow-up on Asia first. In your commentary on the investment bank, you actually called out APAC cash equities as being one of the strong points, and yet in the private banking commentary, you talked about more muted client sentiment in Asia Pacific. So I just wanted to check if you're seeing similar trends in terms of transaction activity in Asia between the institutional client base and the private banking client base, if they are beginning to diverge, or whether your commentary around more muted client sentiment was more to do with the deleveraging point rather than transaction activity. So that would be my first question. The second question, just on the wealth management Americas business. It's interesting that you obviously chose to put out a few slides specifically on that business. When you last gave an Investor Day, I was always intrigued that with Asia, with LATAM, with Europe and Switzerland, there were PBT growth targets for those regions, whereas for the US, it was more about improving the PBT margin. So I think the aim was to get the margin up to 25%. Is that still the case for the US business? Is it much more about enhancing the margin rather than an absolute profit growth target?
Yeah, just in terms of your first question, I guess you're right in characterizing the fact that during the quarter, actually, with some of the volatility, we saw quite a bit of institutional-driven cash equities activity, and we're particularly we're particularly well positioned to capture the inflows and the outflows, kind of the cross-border, sort of the northbound and within China and across China. And in fact, a lot of those volumes came out of our U.S. institutional clients that were looking to trade around some of the volatility during the quarter. Conversely, the uncertainty regarding and in reaction to some of the policy changes was much more concentrated in our wealth management client base, and that did show up in some deleveraging, part of which we initiated, as well as a consequence of that deleveraging, some outflows. In terms of wealth management Americas, overall we're targeting growth. That's the primary focus, and you see that in the investments in the initiatives that Ralph referenced. And we believe that being the largest wealth management market in the world, and given our position globally and also our emphasis in our investments in our ecosystem, we do think that there is additional scale opportunity for us. And we talked about that with some of our investments. And if you look at what we've done traditionally, we've always been targeting to continue to grow our business in the U.S. And if you just reflect on where we were in 2017, really, where we had a run rate in our wealth management business of about $1 billion a year, we now have doubled that. If you look at our quarterly profit for the third quarter, we're up over 43%, and we're well above $500 million. So we're now on a run rate of over $1 billion. And so we're seeing growth in scale in our wealth management business, and we're also seeing growth in scale in our asset management business, and partly the contribution in the ecosystem effect, for example, with the SMA initiative that we launched later last year, along with some of the collaboration revenue we're seeing in the IB, all gives us good confidence that we're going to continue to see good growth momentum there, and at the same time, continued improvement in margin.
The next question is from Jeremy Sigee from Exane. Please go ahead.
Good morning. Thank you. One more follow-up on Asia, please. You've talked a bit already about the net new fee-generating asset outflow and the loan reduction, which were relatively, 2-3 billion kind of size. But there's a much bigger reduction in the total invested assets. That came down by about 37 billion. So I just wondered if you could talk about what those assets were that left the bank and what the drivers of that were. That's my first question. The second question, still on wealth management, the outlook comments warn about seasonality and slowdown and the abnormal activity levels in 3Q. And I just wondered whether you have in mind just the transaction revenue line, or whether that also may affect the recurring fee line as you look about the change from 3Q to 4Q. Thank you.
Yeah, in terms of Asia, the other, of course, impact on our overall invested assets was market performance. You did see market performance in the Asian indexes move down during the third quarter. In terms of the question on asset management, I guess I didn't completely understand it, but just firstly note that if you look at the last 12 months, we've had over 70 billion of inflows, and I highlighted in my speech the fact that we're seeing continued very good net new run rate momentum. So we feel very comfortable that the trajectory of our management fees is going to be positive going forward as a consequence of that. In terms of performance fees, and also I highlighted in my speech the fact that performance fees at 33 million are actually at a more normalized level. What we saw last year in the third quarter, and particularly in the fourth quarter, is we saw outsized performance fee levels, and that was predominantly generated out of our O'Connor, our hedge fund business. And I mentioned that we expect to see more normal performance fee levels in the fourth quarter.
And maybe to add, Jeremy, on the asset management side, this is a bit of a chunky business, right? If you lose a client, you may just lose a couple of billion already there on the institutional side. And you see strong momentum in the wealth management channels, in the wholesale channels. You see strong momentum in S&I, sustainability and impact. The Concord initiative in the U.S., strong momentum as well around alternatives. So there's quite a lot of inflow momentum in the asset management business.
Thank you.
The next question is from Magdalena Stoklosa from Morgan Stanley. Please go ahead.
Thanks very much. I've got two. So my first one is about Americas, because one, you've given us a very good steering where you're going strategically. So with the strategy of growth, how do you think your channels for inflows will evolve, particularly in the U.S. market? Because of course the business model is very dependent on financial advisors. But how do you see it going forward? You've mentioned workplace channels that you're developing. You've of course also mentioned the affluent-oriented mobile channels, and of course the SMAs via asset management. So when you take it all into account, how do you see that future growth channel mix evolve from here? So that's question number one. And number two really is on the capital, because of course you've got a very, very strong CET1. That 14.9% implies a very significant excess. And so how do you think about kind of moving parts here into next year? How do you think about your capital allocation between, of course, organic growth, but also the level of payouts? Thank you.
Yeah, thank you, Magda. So specifically on the US, the financial advisor channel is a very important channel to us, right? I mean that's we grew up with that channel. That is our channel. That's our franchise, and you will see that you see it in the first two initiatives and priorities that we have for the US business are truly to support that channel, to support our financial advisors, to be more effective with our clients, to support them in getting the right advice, the right product in front of them, to support them across the life cycle, be early on if they want to sell their business, involved with the banking services. So the first element of the improvement that we can see is how do we bring more of the ecosystem, asset management, investment banking products, to support the financial advisors. How do we make sure that the platform from which they work is state of the art, so that they basically can focus on client advice and do what they're really good at, and what they're motivated to do. So that's a truly important channel for us. Then even in the second priority around building the banking services like main banking services, we are supporting the financial advisors already through mortgages from our bank, and they do a really good job there. They introduce mortgages, which is important for them to build their client relationship on as well in order to do their own wealth advice. We want to broaden the banking products to support them in their dialogue with our clients, also in the entrepreneur side and the cash management side. So even more so to support them in that and build a continuous dialogue and a strong relationship with our clients there. And then the third one is one which is already a different channel, right? As you said, it's a channel through which we do retirement management and as well as stock management, equity plan management, which is more geared towards a more affluent population, where we already have 2 million clients there, and we feel that if you develop a digital proposition to manage their wealth beyond what they already do with us, or after they basically cash on, for example, some of these stock plans with their company, that we can actually support them to continue to invest wisely through such a digital offering with remote advice. And clearly, if there is an opportunity there that there is also clients outside of our current clients through the workplace services that are attracted to this opportunity, we will also look at that. But it is much more an affluent proposition than the financial advisors are after. So there's no real conflict there. It's really a different segment of the market.
Maybe Magdalena, just in terms of your question on capital, certainly we have the luxury of actually sitting on top of a significant buffer versus our overall 13% guidance, which holds. And so our intent still is to return any excess over 13%. Now, on the one hand, that does give us strategic flexibility, but clearly it also gives us some good potential to return quite a bit of additional capital to our shareholders. Also, we continue to have the guidance that we are going to balance those returns in favor of buybacks. Now, we'll have an update overall on our capital return policy in February, but I think you can expect us to continue to have a very important emphasis overall on share repurchases as we get into next year.
Great. Thank you very much.
The next question is from Stefan Stalmann from Autonomous Research. Please go ahead.
Yes, good afternoon. Thanks for taking my questions. I would like to start with Broadridge. You have not mentioned this project on your Americas slide, and if I remembered well, this was now the crucial period of this project going live. Could you maybe provide an update on how this is going and also flag any particular cost increases that may or may not happen during this implementation and transition period? And the second question, a relatively broad question on greenwashing. That's, I guess, an evolving discussion point in the fund management industry. And I was curious if there's any concern for you, first in your own production and asset management, but also in wealth management, given that you're probably selling a fair bit of third-party funds with, ESG credentials to your clients. Thank you very much.
Yeah, thank you, Stefan. On your first question, I actually think I did mention it in Building on Scale, which is I refer to the platform through we support our financial advisors, which is basically it's what we call VMAP, which is basically developed in collaboration with Broadridge. That is continuing. It's a project that had its challenges, as you may know. In the past, we have replanned that project. We are releasing in batches. At this moment, there is FAs working with it, and with their feedback, we further improve things. So that will be released over time in separate releases. But that is certainly a project that we are committed to finishing, and what needs to be finished as well, for two reasons. First, we need this platform to support our financial advisors to do their work efficiently and improve their productivity as well. But there's another side to this as well. We feel that this could be, or this will be, an industry standard for many other parties to work from as well as a core platform for financial advisors, and therefore it could be also licensed to other parties to use, which will then further decrease the cost to us. So it's very much on one side a productivity play, and on the other side a scale play with third parties bolting onto that as well. On greenwashing, are you?
Yeah, I think, of course, as you noted, there's an awful lot of focus in general on sustainability, and obviously with that comes greater scrutiny, and we certainly have seen that. We haven't seen the last of that. We would note that we feel comfortable with what we report related to ESG and sustainability. I think you've seen in the slide presentation our sustainability focused assets overall, which sit across our three businesses, so asset management, wealth management, as well as P&C. We also have reported this in our sustainability annual report, and we're very, very comfortable with the data that sits behind this. I think one of the challenges and complexities that we all have in the banking industry is the fact that we don't have defined standards. And with a lack of defined standards, you could always point out something that's reported that might be inconsistent with some other standard that exists in another jurisdiction. So clearly, we're very hopeful that we start to get some convergence around standards and what is expected of the banking industry. Our objective overall as a leader in sustainability is to continue to reflect best practices and all the reporting that we provide to the market, and that is something that we're very focused on ensuring.
Great. Thank you very much for that.
The next question is from Adam Terelak from Mediobanca. Please go ahead.
Morning. Thank you for the questions. I've got two, one on GWM flows and the other on capital into next year. On the flows, obviously net new fee generating assets is still very strong. I just wanted to get a bit more colour of kind of the structure of those flows behind the scenes. Are these into advisory, discretionary mandates, or is it third-party funds? And how that looks in terms of the margin on the business coming in. Because clearly the fee margin on being reported each quarter on fee generating assets has been very, very stable. So just some commentary on that and the outlook would be great. And then secondary on capital, in terms of payout for next year, I think an important input this year has clearly been your regulatory inflation. Your numbers this quarter and next have kind of gone up a little bit on that front. Could you just give us a colour for 2022 in terms of any inflation to come through? And then on the prime 2 billion you're highlighting in the report, what's the basis for that? Is that to do with the losses incurred on Archegos? Is that to do with more technical detail on the exposure? Just how that's been calculated in terms of the add-on with FINMA would be great. Thank you.
Thank you, Adam. Just in terms of the overall flows and mix that go into net fee generating assets, I think, as you know, we've defined that principally as mandates. So the bulk of the total net positive flows are comprised of mandates, and they're really a full range of mandates that go from fully discretionary managed to actually an overall under contract mandate product where our more professional clients actually have full discretion and are comprised, the overall mix of revenue is much more oriented towards transaction revenue. And in terms of margin, we're not necessarily just focused on margin. We're focused much more on overall revenue and operating income growth, and just we're very comfortable that this is a good measure that references quality of flows. And also we are seeing, of course, we're driving overall top line revenue. And you see that in terms of the 23% net recurring fee income growth versus our overall invested assets only growing 16%. In addition to mandates, there is some mix of funds, but that's a smaller proportion of the total inflows than mandates. And also alternatives are included as well within that overall metric. In terms of your capital question, I think you've seen we highlighted the fact that we did see an increase due to some regulatory add-ons, and that's not a new theme. I think it's an unfortunate part of banking that we do get regulatory add-ons. We mentioned the fact that we expect another 2 billion related to prime brokerage, combined with the around 1.5 billion. And as I mentioned, you do see that detail on page 42 of our report. I think you can consider that of model and technical nature. It's not due at all to any losses or any other factors related to our prime brokerage business. And I think you heard me note that prime brokerage was an important contributor to our year-on-year performance overall in our investment bank. We haven't provided yet an update on what we expect in terms of regulatory add-ons, and that is something that we would intend to highlight during our February update. But needless to add, I think with the the substantial surpluses that you see we have in capital, we're still very, very comfortable with the flexibility we have and our ability to continue to return capital very, very attractively to our shareholders.
Okay. Is it fair to say the market risk update was one of the bigger items to come through there?
That's right. The market risk update was another one, and that was a larger one. It's part of discussions that we've been having with FINMA since 2019, and that's been fully absorbed.
Great, thank you.
The next question is from Andrew Lim from Societe Generale. Please go ahead.
Hi, good morning. Thanks for taking my questions. So the first one is on personal and corporate banking. It's often seen as a sleepy division with very little growth, but for the past 2 quarters now, you've had some good growth here, and across the 3 main revenue lines. You've talked about deposit optimization as one strategy, but I'm just wondering if you're seeing something broader driving the growth there in transaction-based income, NII, and recurring fee income that we should be taking note of going forward. And then secondly, you talked a lot about your digital strategy, including developing a full-scale digital bank in the US. I was wondering how crypto sits within that, whether you're merely just going to offer ETF products to your customers, or whether you're thinking about offering trading, custody, or even lending based on crypto, or whether it's something that you feel is valueless within the grand scheme of things. Thank you.
Yeah, let's start with the second question as to crypto. I still feel that the market, not many players understand the true value of crypto, what determines the value of crypto, what the uses of crypto, and therefore I think it is not something that one can regard as an investment, but is much more. It's more about speculation. Now, we don't advise on speculation. That's what it is, and that's why we don't go there. And so if clients want to do it, they can do it, but it's not going to come. It's not something that we will actively offer ourselves. So on your P&C business, no, you've seen that the P&C business is indeed making a good comeback here on all dimensions of income. It's got to do with the normal economic activity that you see coming up again. You see in the first quarter of the year, you saw companies still repaying under their COVID facilities, and now they're drawing down on their new facilities in order to support the growth. They need working capital. They're investing. You see more activities there. Then you see the mortgage market continuing to develop interestingly as well, and therefore you see the net new loans also there increasing as well. So that's what impacts NII from a growth perspective. Then that we introduced a deposit pricing scheme where we have engaged with customers with deposits over 250,000 francs as to charging them on their deposits, and we have gone through this on a client-by-client basis as to how we better price either for deposits or for alternatives. Therefore, you've seen the NII also improving from that perspective. Then with the opening up of the economies, you see more spending, you see more international spending. Therefore, you see our credit card revenues going up as well. So it's really it's almost I think it's a picture you can expect from all domestic banks in the world. Economies opening up, businesses investing, businesses growing, needing working capital, mortgage markets being interesting, not only because of the low rates, but also because clients dare to move again. And then you see much more spending, and therefore you see much more transactional income. You see much more credit card income, et cetera, et cetera, et cetera. So clearly we were ready to benefit from that. So our team did a really good job being ready for all of this to happen. At the same time, we have to make sure that we do an even better job at servicing our clients digitally, and that's why we are making the plans and implementing the plans as I said.
That's great. Thank you very much.
The next question is from Benjamin Goy from Deutsche Bank. Please go ahead.
Yes, hi, good morning. Two questions, please. One on capital and the second one on GWM lending. First, a follow-up there. For your new capital targets, or how do you think about Basel IV or finalization of Basel III inflation going forward? Should that change to 13% or target, and everything in excess is, so to say, up for payouts? And also, how do you think about a potential M&A buffer in your capital ratio? Some banks and financial institutions have this incorporated, in particular considering you are supposedly looking at some asset management transactions. And then secondly, you mentioned GWM loan growth was in particular driven by mortgages and Lombard loans. So I was wondering whether we should expect, so to say, a bit more capitalized loan growth going forward in that division, or an increasing focus also on structured lending going forward. Thank you.
Yeah, so in terms of capital, just to reiterate again, our intention is to return all excess capital above 13%. And naturally, we welcome the strategic flexibility. In terms of your point, would we ever retain a capital buffer for acquisitions? It's not something we certainly would believe in. We wouldn't want to retain capital that is actually not being put to work on behalf of our shareholders, or being provided to our shareholders for them to put the capital to work. We would also note that we have built-in flexibility because of all the capital that we generate each quarter. I mean, you saw that we generated 6 billion year to date. In the quarter itself, we generated 2.8 billion. So that alone gives us flexibility. If we see some strategic opportunity, we know that we're likely to generate pretty significant capital to be able to help us address that opportunity. Now, in terms of GWM and our lending focus, you are correct. The majority of the loans that you've seen year to date, I guess 231 billion is our total lending portfolio in GWM as of the end of the quarter. 147 billion of that, or almost 65%, is Lombard, and then another 30% is mortgages. And that's indeed where we've been seeing the preponderance of growth. Now, at the moment, only about 5% of our total lending is what we would consider to be structured, so more single stock financing subscriptions of that nature. Now, our intention going forward is that you would expect that we're going to continue to generate very good flows across Lombard and mortgage, but we will continue to look on growing our structured lending. We do see client opportunities, particularly within our entrepreneurs, where there is demand for that type of lending, and that is a part of the market that we want to continue to address. And also, you heard Ralph talk about launching the broader banking platform in the U.S. That's also going to create other sources of lending flows in other areas related to bank lending. And so that's another lending or loan growth opportunity for us going forward.
Very clear. Thank you.
The next question is from Anke Reingen from RBC Capital Markets. Please go ahead.
Yeah, thank you very much for taking my question. The first one is just on cost. You made a comment that you said, yeah, it's already helped the performance year to date. It's already helped by your cost program. But I just want to confirm it's a relatively small benefit out of the 1 billion targets you previously mentioned. And I just wonder if there is any update on potential restructuring charges, Q4, I guess not, or early next year. And then secondly, you talk a lot about working across the divisions within UBS, and you obviously already have some benefits with asset management. But I just think in terms of the whole potential, where do you think you currently stand, and how much is incentivize the divisions to work together, and how much more is there to go for? Thank you very much.
Yeah, thank you, Anke. Well, the cost plan, I mean, there is a bit of impact here, but the real impact of the cost plan will actually come through our 22 and 23 numbers. And we can give you much more detail on that also in February as to how we plan that and where we see then also the room to translate that into investments on the other side, to the extent these investments make the returns that we expect them to make. On the restructuring provisions, for example, we had expected that a little bit higher, but what we see is there's quite some attrition because of the markets as well. So from that perspective, the market is helping us as well because there's also voluntary leaves happening, et cetera. So no major. I'm looking at Kurt at this moment. At least for the third quarter was
66 million in the third quarter after 90 million in the second quarter, which, as Ralph said, is lower than we expected. Any further update on restructuring related to the 1 billion, we'll update you on in February.
Yeah, exactly. And your second question was on
the second question was on collaboration revenue working across the business division.
So it's a very good point there. Clearly, as you know, we're trying to ensure that UBS is more than the collection of divisions. We truly believe that we work for one and the same client, and we have to look at ourselves plus our partners as ones that work in an ecosystem of capabilities that we want to deploy with our customers in order to support them in developing their wealth. For that, you need a further collaboration, which is happening in many different areas. If it has to do with wealth and investment banking working together on the specialized lending, on the direct access to the markets, or the wealth with asset management in the US, for example, under the Concord program and the SMA product offering. So where we feel the opportunities are there, we will certainly do so. You should realize that the top of the house, which is the executive board members, we all have the same financial KPIs. Nobody has a divisional KPI specifically, which makes sure that the top of the house is fully collaborative, making sure that our clients get serviced the best product and best service from the products that we have or source from others. So quite some changes already made this year in order to make that work.
Okay, thank you very much.
The next question is from Daniel Regli from Octavian. Please go ahead.
Good morning. Thanks for the presentation and for taking my question. I have 4 questions. One on NNI, particularly in Global Wealth Management. As I understand, the margin expansion you have seen is mainly due to deposit management or optimization. Can you give us kind of an idea of what the current interest yield curve shape has for an impact on NNI in this quarter or maybe in the shorter term to longer term outlook? Then secondly, on IB revenues, obviously, and we are waiting for the kind of normalization in IB revenues for a while now, and banks repeatedly were talking about the normalization in revenue for Q3, and now you again posted a very strong quarter. Can you give us kind of an outlook here on what do you expect going forward in terms of IB revenues, also with regards to pipeline, maybe deals pipeline for Q4? And then thirdly, again, maybe...
Hey, Daniel, it's Martin here. So just the rule is 2 questions per analyst. So we'll take these 2 questions and take it from there, please, right? Because we have a few more people on the quue. Thank you.
Hey, I will start with your second question, Daniel, here, which is on the outlook. So if also going by my introduction, you see that companies are really kind of looking at the opportunities to build scale in this market, to benefit from new business models, to look for further opportunities to grow as well, looking for capabilities to add to their core businesses, and therefore the current momentum that we see in the market in terms of M&A, the advisory side, to the extent the markets hold up on equity capital markets, we actually think it looks good for the next quarter. I'm not going to go into where this is going to be in the next year, etc. Who knows? But currently that looks good. Markets continue to be constructive overall in what we see as well. Also this month, so from that perspective, we think that the markets are constructive both on the advisory side as in general as well.
So Daniel, in terms of your first question, if you look at our NII on a year-on-year basis, the majority of the growth was actually generated by lending, as you would expect in GWM with the 21 billion of net new loans we've generated this year. And also overall margin has improved slightly, but we've maintained our margins on those loans. Now, quarter on quarter, we actually did see a good increase in overall deposit NII. And that was predominantly generated by increase in flows. And so we've actually seen quite a good buildup in volumes over the last 3 quarters. In addition to that, we had some other non-NII or non-margin specific contributors to our overall NII for the quarter, and that included some revenue from some sale of some available for sale securities in the U.S. that helped us. Plus, you heard reference to the repricing that we've done for clients above 250,000. That also helped us a bit in the quarter. Going forward, if you look at our NII, the main factor that will drive revenue will be flows as we look into next year. I referenced that quarter on quarter we expect to be stable. If you look at the shape of the curve currently, there is some expected increase on the back end of the curve, but that really won't help us until 2023. And it really takes a change in short-term interest rates to help us on the deposit margin side of things. Beyond that, I think you heard an earlier question about the 100 basis point increase, which leads to 1.6 billion, but that's very theoretical.
Okay, thanks a lot, and apologies for asking or wanting to ask more questions.
No worries.
The next question is from Amit Goel from Barclays. Please go ahead.
Hi, thank you. So 2 questions. The first is, to be honest, I'm still a little bit struggling to get my head around why the group isn't returning more capital already via buyback or other means. Obviously, when I look at the ratio relative to the target, I see the commitment to get back to the 13. Obviously, there's the French case out there, but even that, when I look at the theoretical surplus, it seems to not be such a big factor. Last year there was the additional buyback accrual. So really just trying to understand, what exactly we're waiting for, in terms of seeing more money coming back to investors. And then secondly, just a question, maybe coming back on APAC, but just wanted to understand a bit more in terms of exposure to heavily structured product, whether you see that as an area of risk and/or risk management, or whether that's an area that you're looking to continue to grow as we go through the coming periods. Thank you.
Yeah, I don't know how many different ways I can answer the question, Amit, about returning capital. But I think I've already been very, very clear. Our intention is to return capital above 13%. And you'll hear more about our plans to return capitals going forward. You can do the math, and you know that there is ample opportunity for us to continue to engage very actively in buybacks. Now, also, I would mention that if you look at the one constraint we do have, it's we generally will repurchase up to about 25% of our shares any given day in the market, just so that we're not overly influencing price moves. So you can also factor that in, and then look at the number of business days that are available in a quarter, and that will give you a little bit of a view in terms of the limitations around buybacks. In terms of your second question, it's just a little. I'm confused by the way you ask it. You say that are you going to engage more, implying that we are already engaged and exposed to heavily structured products in Asia. I think if you look at our Asian business, naturally we are exposed to structured products. That's in particular is a big part of our equity derivatives platform, both on the side of our investment bank, where we're very focused on structured derivatives, and that's not just in Asia Pacific, it's across all markets. We've actually rebalanced our equity derivatives business, so we got a much better mix of flow and structured product exposure overall, which has been very constructive for us. And then we're also exposed on the distribution side for our wealth management clients, as they tend to like to invest, particularly when they see volatility in the marketplace. They like to invest in structured products, and we generally, and we referenced one of the reasons you saw year-on-year growth in our transaction revenue and wealth management is because we did see higher structured product revenue. But again, not just Asia Pacific, but really across all regions.
Yeah, which is different from structured lending, right? So, which is different from structured lending. So it's just that you know.
Sure. Yeah. So I was kind of asking in relation to perhaps a bit more the structured lending, and essentially some of the comments about asking clients to deleverage to some degree, whether or not how you think about the growth of that business and or risks within it.
Yeah, but the deleveraging was not particularly geared towards the structured lending activities. The deleveraging is just about making sure that the Lombard loans as well and the LTVs and the Lombard loans that they get honored, and depending on the concentration under these loans and the movement of some of the underlying stock, the question is, okay, how do you kind of recalibrate your portfolio to be more diversified, more internationally diversified, et cetera, et cetera. And that's the discussion that went on, and that's how we also support our clients through a change in sentiment and by recalibrating their portfolio. So on the structured lending itself, I know that Asia is a market generally more open to structured lending. Our exposure is limited to that to a certain extent there. We are pretty conservative on the risk side if it comes to very specific structured lending also in Asia. We do think it's a good business, but we do it with some conservatism, as you know.
Yeah, and I think you heard me mention that our structured loans to total loan portfolio is about 5%, and we do intend to do more structured lending, but as Ralph said, on a very selected basis.
Cool. Thank you.
The next question is from Tom Hallett from KBW. Please go ahead.
Hey guys, thanks for taking my questions. So if I remember correctly, you said something like 70 trillion of wealth will be transferred to the next generation in the coming years. So I guess what I would like to know is what's the track record of UBS, say, over the past 5 years, for assets that have been transferred down from, say, one generation to the next. So, is it sort of 80%, 90%? Any sort of indication around that would be good. And for those that don't convert down the generations, why is that? What's typically driving that? And then secondly, could you provide more color around the associate loss in asset management, please? Is that something we should expect again, or is that just a one-time thing? Thank you.
Okay, the second one is a one-time thing. And the first one, I don't have those numbers, Tom, but in general how it works is that clearly, the transfer of wealth from one generation to the other may come with a choice for either a different advisor or a different channel altogether. As you can imagine, it's a new generation, and that is why it is so important that we have different channels in the market, different offerings in the market as well. So the numbers I really don't have here at hand. I owe those to you to the extent we even have them. But it's certainly it's looking at, okay, if you have generational transfers, do you need to have different coverage, different financial advisors, or different channel altogether in order to manage that? And in general, what we do is we're very early on in these discussions. As you can imagine, the transfer of wealth from one generation to the other, specifically if it also has to do with the underlying business itself. So the transfer of the business that is being run by one generation to the other comes with quite some emotion sometimes, with a lot of advice and with a trusted relationship. And honestly, that's exactly what we do. This is exactly what we do. We have these discussions pretty early on. We take our clients through some of this, make sure they feel comfortable before they even take the decision. And then once they take the decision, we also make sure that every step of the way they understand what's happening. And so this is what we do. This is our business.
Maybe just to add to that, well, part of that, as Ralph mentioned, is a real focus on the next generation. In fact, we have a number of very active education and content programs that we offer to the children of our wealthy clients, and we do that very proactively, including running overall events. We bring the children together of wealthy clients so that they can interact as well, and we find that we start to build and create actually that confidence and that linkage at that earlier age, and it's obviously very helpful to that transition point that occurs later on.
Okay, thank you.
Hey, in absence of further questions, I'd like to thank you for calling in and staying with us this morning. We are very proud to deliver such a good set of numbers, record numbers from many different dimensions. And that's thanks to our clients and that put the trust in us, and thanks to our colleagues here at UBS that support our clients all the way through some of these uncertain times. We're very proud here, but by no means are we complacent. We have developed some plans that are very interesting and that we feel will fuel growth also for the future, not only now. And we're really looking forward to seeing you in the next quarter when we can give you a full update on those plans and the resulting targets from that as well. Thanks very much.
Ladies and gentlemen, the webcast and Q&A session for analysts and investors is over. You may disconnect your lines. We will now take a short break and continue at 10:45 with a media Q&A session.
Welcome, everyone, to our third quarter media Q&A. Thank you all for joining. I'm joined here today in the room by Ralph Hamers, Group CEO, and Kurt Gardner, Group CFO. I'm going to turn over, operator, to our first question.
The first question is from Albert Steck from NZZ. Please go ahead.
Yes, hello. Good morning, and thank you very much for taking my question. I have two questions about Agile at UBS. My first question, how did you get inspired for this concept? Are these primarily approaches that are used at technology companies like Spotify? And how realistic is it to implement such a concept at the bank, which is, of course, based on a much more hierarchical tradition? And second question, just shortly, can you give an example of a department where Agile at UBS is already being used, and how is this working in practice?
Sure. Thank you, Albert. So the Agile way of working is basically a way of working in which you put hierarchical teams together into, and you mix them, and you make multifunctional teams, and they collaborate on 2-week sprints under 3 months directions, coming from the top of the house, basically, in terms of priorities and direction. How do I get inspired? I got inspired, but that's already 7 to 8 years ago, by the different players, indeed, on the technology side. That's why I introduced it in my previous bank. Since then, many banks have copied it. So it's been, I think there is not a lot of banks that don't work Agile, and therefore we feel it's a good solution for us as well. It's a tested way of working. It's nothing new, but it will bring a lot of change. That is true. But it's not like it's never been done before. On the contrary, it is done. It's done in many places, in many banks before, and we're going through this. So your examples as to where we work agile already is that within UBS, the front runner in the agile way of working is the investment bank. They feel the heat of the market the most, so they know that they have to change all the time, that they have to anticipate changing client needs all the time, that they have to be productive and efficient every time, and therefore it was adopted there first over the last couple of years. And the back of that experience and a further development of the model we think works well for UBS. We are now piloting it in Switzerland with our local business. We're piloting it in global wealth management as an I, and we're piloting it in our HR environment. Currently 3,000 people are in that pilot, and we will basically enlarge that to 9,000 people as the next stage, and 25,000 in total by the end of next year.
Well, thanks a lot.
The next question is from Song Yun Sim from AWP. Please go ahead.
Yes, good morning. I also have a question on Agile at UBS. You said 9,000 people are to be transitioned to Agile at UBS, but I would like to know what does this exactly mean? How is this Agile at UBS to be understood? Is this like a new division? Because I understood that you want to become agile within the whole company, but I don't quite understand the expression of the transition of the people in regard of that. And second question, did I understand you correctly that you are in regards of your strategy refresh and growth initiatives that you're aiming to, that you're more focused on your existing clients in the first step? And also, what about the attraction of new clients? Thank you.
Well, to start with your second question, clearly it's always important to ensure that you focus on your existing clients. I mean, they have been there, they are loyal, and they should get the attention they deserve. There is always an opportunity to do more with your existing clients, and generally it's also the easiest way to grow your businesses with your existing clients. Now, clearly, there is also initiatives through which we want to attract new clients, and you can do that through new products. And that's, for example, what we plan to do in the US, where we feel that we have the opportunity to introduce a digitally led with remote advice offering to our workplace wealth service clients already. And we can also attract new clients with that service concept as well. Same goes for Switzerland, by the way, where we feel we can grow faster in the market in some areas like sustainability, like mortgages, private pension activities as well. So we will also be able to attract new clients around new products there as well. Going back to the agile way of working. Yeah, this is really difficult to explain to you over the phone. I think there's so much material on YouTube that you can watch in order to educate yourself around agile way of working. In essence, what it means is that if you change processes, or if you want to go after an opportunity in the market, then generally, the marketing function would spot this opportunity. They would they would do customer research. They would come up with a business plan or a business case to introduce a new product or a new service. And then they would send it to the product department that then will develop a product in order to cater for that new service. They will send it to the process department, and they will develop a process in order to make sure that that product is delivered to the clients for that service. And they will set up the requirements for then the technology department to actually make it a digital offering, or any bank offering is these days digital anyway. So now you can already hear on my explanation that this is like 4 different departments with handovers, which will take long lead times. And generally this takes like 12 months, 14 months with all the research, and before you're to the market, the opportunity is gone. So what you do is, rather than you have these 4 large departments that work by themselves as islands, you make sure you have 2 people from the first department, 2 from the second department, 2 from the third department, and 2 from the fourth department. And now suddenly you have an 8-person pot, as we call it. And these 8 persons, they go after this opportunity. They spot the opportunity. They develop the product. They develop the process, and they automate the process, all within the same team. Then you get much faster to market, and you do it so this is called agile way of working. You do it faster, and you have a larger chance of success.
But the 9,000 people that are to be transitioned, they are not actually physically transitioned.
Oh, they will.
Am I correct?
Yeah.
Okay.
Yeah, they will be transitioned
to where? Yeah.
To where? I mean, so where they now sit on floor number 1, 2, 3, and 4, they will be mixed over floors 1, 2, 3, and 4. But they will be mixed, and they will mix. They will work in pods. Every 2 weeks they may change even pods. Every 3 months they may even change the leaders they have as well. So for sure they work in different constellations. But then again, everybody can work remote as well. So it's always you can always change teams as well. So they will move from one physical department to an area where they work all together, right? So so there will certainly be a mixing of people. Absolutely, yeah.
Okay, thank you.
The next question is from Owen Walker from Financial Times. Please go ahead.
Thank you very much. Good morning, Ralph. Thanks so much for your time today. Hi, I'd like to know a little bit more about the US digital advice model. And I appreciate you'll be providing more details in February. But at this point, is there anything more you can say in terms of, presume this is for the mass affluence, especially given it's in the US, and it sounds like it's a 2025 vision, but are you expecting it to launch before then, or a soft launch before then? Will you be looking to acquisitions to support this? And also, has perhaps the experience we've all gone through during the pandemic helped with this? Because maybe people in that category, those mass affluents, their expectations of dealing with advisors and banks has changed somewhat if they've been using more digital tools over the past 18 months. Any thoughts on those would be much appreciated. Thank you.
Well, it's true that I think the adoption of digital channels has increased very rapidly during the pandemic. It's absolutely true. That is both on basic banking services as well as these wealth services. Having said that, you will always, certainly if you start managing your wealth, somewhere in your decision making, you would want to have somebody kind of confirming to you that what you're doing or what your robo algorithm is advising you to do is the right thing to do for you. So that's a little bit where the advisor comes in, right? So I think the strength of our offering will be in what makes us strong already, which is going back to our DNA. We're very strong on content. We have strong CIO advice on one side, and we're very good at advice in terms of, building that relationship with clients, or at least giving that trusted advice to our clients. And that to combine with a digital offering that people will access first. So basically, the whole idea is that these indeed affluent clients will get access to a digital offering that generates within their own profile and risk appetite the best portfolio of investments, and that to the extent they want to make changes to that because they see something they don't like, or to the extent they want to know for sure that is the right thing for them to do, they can kind of get access to a remote advisor to take them through the advice there before they take the decision and push the button that this is indeed the best for them. We do think this is a growing market. It is a tested proposition on the back of the research that we have done. So that's why, we're quite positive about this one.
Great, thank you. And just in terms of timing, is this something you expect up and running by 2025, or that's a planned start date, or I don't know if you have any plans on the roadmap?
So up and running by 25 for sure. We would not kind of announce now something that we will not have up and running by 25. So it's a digital play, so it will hit the market somewhere next year.
Okay, right, thank you.
The next question is from Paul Davis from Bloomberg. Please go ahead.
Oh, hi there. Good morning. So a couple of things. One on within the sort of the equities trading business or investment banking prime brokerage. I'd love to know a bit more about what's going on there. You mentioned record balances, and you referenced, I think, some new hedge fund launches. But I'm interested in how much you think you might have taken market share from others in growing that business this year. And then within the wealth business, I mean, again, in Switzerland, I think you've seen pretty strong, new asset growth there. I'd love to know whether you think that's market growth or whether, again, you're taking market share from local rivals. And lastly, in the US, in global wealth, obviously very strong, big new lending. It's driven your kind of net interest income growth. You're seeing a result, the kind of result there that none of your US peers are seeing, I don't think. So what are you doing differently? What are the risks that you're taking? What is the business that you're winning that's expanding your interest income and your wealth business there that others aren't getting? Thanks.
Yeah, Paul, I think on the US it's actually pretty simple. We're just not big in lending, and we don't have our fair share in the relationships that we have with our wealth clients if it comes to their lending. And offering the lending vis-a-vis the penetration that we have on the wealth side gives us quite some upside in doing more lending without taking more risk than what others would do, or more risk than what would be our appetite. So this is just, we've always been a wealth manager. We've seen the success of our banking services to support our financial advisors to build up that relationship on the mortgage side specifically. And we feel there's an opportunity to do more on the entrepreneurial lending side and the cash management side. Those are the products that we want to kind of make digitally accessible and for our financial advisors to introduce to our clients there and just build up a portfolio that is just getting closer to the penetration level as to where we are from a wealth side. But if you grow from a low base, you can show big numbers, right? So it's but again, it's just nothing more than just going after the opportunity and our fair share of the business with our clients. Kurt, yeah.
Yeah, Paul, in terms of our prime brokerage business, we indicated it was a very important contributor overall to our equities results for the quarter. We also indicated that we had record balances, client balances from that business. Ralph mentioned that we did see some new clients, some new hedge funds. But I think overall at this point, we couldn't make a comment as to market share. Obviously, we haven't seen our European peers report yet. We did see our U.S. peers reference prime brokerage as well as areas where they've seen significant growth. So on balance, we couldn't really conclude one way or another if we've taken share. I would mention, though, and this is an important point, that if you look at the overall capital that our IB deployed this quarter, they always, and consistent with what they've done in the past, they stay within the 1/3. And you'll see that as a discipline that our investment bank actually maintains, even when there are quarters when they could have deployed more capital and generated even better results. And that's just consistent with our overall model. In terms of our wealth management business in Switzerland, indeed, I think if you look at the last 12 months, we've generated 8 billion of net new fee-generating assets, which is overall an 8% growth. Also within P&C, and of course this is more of an affluent statement, we've generated 2.1 billion of net new investment products, which are quite similar in nature to net new fee-generating assets, and that's a 16% growth. Now, certainly we know part of that has come out of cash deposits, so it's not a net new share. We had some of those deposits with our clients, but we also know that portions of both of those numbers are also net inflows. Now, again, I think I can only mention that we believe that we gained share, but I just don't have the market details to be able to support that or confirm that.
And sorry, and very quickly on the American business then. So those clients that you're now lending to, were they underserved in general before by the market? Did they not have mortgages, or are you convincing them to bring their debt over to you?
It's the latter one. It's the latter one. Yeah. So right. We certainly don't want to leverage them more per se, but this is really having a competitive offer vis-a-vis the competition that currently does their banking and us doing their wealth.
Yeah. Cool. Thank you.
The next question is from Christian Hetzner for Fortune. Please go ahead.
Yes, good morning. Many thanks. Two questions from my side. Just the first one regarding your comments earlier during the analyst call on advising or not advising about cryptocurrencies. Your customers, whether they're hedge funds or wealth management customers, you advise them on complex structured products where there's all sorts of difficulties trying to determine risk and value. How is crypto any different? Could you please elaborate on that? I understand, we're in a situation where we're sort of in a bubble in general. If you look at Tesla's market cap rising 100 billion yesterday, overall, wouldn't the entire environment be very difficult in determining accurate value? And how are you then advising your clients to react in this sort of potentially stagflationary market? And then secondly, on the issue of sort of a political issue for your bank in Switzerland, the Swiss Federal Council is holding a vote, I think on the 28th of November, if memory serves. This could potentially have ramifications for the Swiss economy in general if people vote no. Do you have any concerns, and would you support vaccine mandates going into winter for your Swiss staff? Thank you.
Okay. Well, the last question I didn't really understand. So which one are you referring to? The confirmation of the COVID facilities in the past, or
mandatory vaccines?
Basically, the agreement with the EU that people can travel back and forth and freedom of movement for Swiss citizens. I believe that's the COVID-19 law that people have to vote on the 28th.
Okay. So on the first one, let me first tackle the first one then. So Christian, so crypto versus some of the structured products, right? So I agree with you that the market seems to be priced for perfection, and we see that, so with news coming through on central banks, starting to taper, or with geopolitical tensions flaring up, you see the market reacting already. So you see that we are close to price for perfection. It doesn't mean that we don't understand how the value is built up right now in terms of the products that we offer, because it's just the fundamental analysis of the parts of it, and clearly, central bank policies have helped in terms of the level of asset prices, etc. But nevertheless, we know that because of central bank policies, some assets are more in demand than others. I wouldn't be able to tell you what makes the price of a cryptocurrency. I just wouldn't. To the extent I don't know how to do it, and I don't know what liquidity will truly be there when things go wrong. I don't think this is a category for investment. This is a category for speculation, and we're not in the business of that. It's just what it is. Now, doesn't mean that for some clients, if there is reverse inquiry, we will honor some of that from a reverse inquiry perspective. But it's certainly not something that we advise.
Right, so it is a sort of a branding risk. You fear that the image of the bank could be damaged.
No, it's not a branding, Christian. It's not a branding risk. It's not. It is just that if you don't understand it, how can I advise it?
Mm-hmm. Okay. Very clear. Thank you.
Okay. Yeah, and the second one, I'm still just looking at this. What
are the ramifications?
Yeah.
There's none, right? Because if there's if the certificate gets deleted, they will come up with another certificate so you can travel internationally. It has nothing to do with the people being able to travel or not. It shouldn't have any economic ramifications.
Well, let me come back to your second question, because I first want to understand what the real point is here, whether that is put to a vote. So, yeah. Well, it's clearly not on our radar as an issue, so I guess we don't see it as a ramification for our business. Otherwise, it would certainly have hit my desk, but maybe that's the answer already, Christian.
I just remember comments from the president of the Conference of Cantonal Governments saying that it could be devastating to the domestic economy if the outcome of the vote was no, and it would, as he said, pull the rug out from under their feet in this crisis situation. So there was some, clear concerns on the part of the government that its populace might revolt on this measure. But perhaps then on the sort of the underlying issue, would you support vaccine mandates for your Swiss employees in the Universal Bank? If you haven't already.
We live in a democracy, and we go by what the Swiss federal government rules as laws, and we abide by that. For us, the way we currently work, as you know, is we are slowly but surely coming back to work. We have introduced the hybrid way of working, so people can manage the days they work in the office and they work from home. And I've earlier said that also provides for a solution for people who rather work from home or don't want to kind of be a source to affect others to the extent they're not vaccinated themselves. But again, that is up to them. And apart from that, we abide by the laws that this country has.
Many thanks.
Thank you. Thanks.
The next question is from Andre Müller from NZZ. Please go ahead.
Yeah, good morning. Just two questions from my side. The first concerning Switzerland and net interest income, or more specifically the introduction of negative interest rates or this deposit pricing scheme. If you look at it from today's point of view, how important was this step in improving your fee revenues, your mandate penetration here in Switzerland during this year now? And say, are you happy with the way you have introduced this new pricing scheme, or is there something you could have done better? And then the second question concerning the tax environment in the US that you have mentioned quickly in the analyst's presentation. Could you give us maybe possible scenarios? How would and could UBS adapt to a higher business tax rate and would also higher taxes for the wealthy? Would that be a very specific concern for you, where you would need to adapt in some ways?
So on your first one, Andre, I think that the introduction of negative rates, we've done that in a very careful way. You know that we have introduced that for deposits over 250,000 francs. And that we have done it in a way that we actually engage with our customers to see, how to manage their surplus cash, whether there were alternatives, and what would be the better way for them to solve this issue. And I think we've done that really well. You've seen that certainly the NII has a bit improved on the back of that. Some of the investment products flows have also originated from that as well. But again, this is all within the way we approach clients, which is on a full and a transparent advice way to make sure that we do what is good for them. Kurt, on the U.S. taxes.
Yeah, on the U.S. tax side, if you look at on the business tax side, the corporate tax side, of course, there's still some speculation. I guess right now, if you think about what might be a reasonable compromise, it could be in the area of 25%. Now that would imply a 4 percentage point increase in the tax rate, which for us would imply that we would write up our DTAs by 1.2 billion, so that equates to the 300 million per % increase that I referenced. Now also, of course, the advantage for us is the fact that we do have available net operating losses. We can shield ourselves from paying taxes through around 2028. So this would have virtually no impact overall on our cash taxes. Importantly, though, it would increase our tax rate because we would see amortization of DTAs that would have to take place. Now, in terms of more broadly any impact, and there's still a lot of speculation around what the wealth tax might be. It's not even, of course, sure that there will be a wealth tax, and there continues to be a fair bit of debate. So it would be hard for us to speculate right now how that might impact our business overall.
Okay, thank you very much.
The next question is from Niklaus von Tobel from CH Media. Please go ahead.
Yes, hello. Could you say something about the Chinese market, how you're viewing the political risks there? There have been some rule changes which has affected many businesses quite severely, and there is this new strategy of common prosperity. And last thing I saw from UBS, you were still quite enthusiastic and recommending to clients that they increase their exposure. So I wanted to ask what currently your views are.
Well, Niklaus, this is not a call to give investment advice, so let's put that proviso here on the table. This is a call as to how we see China as a market and how we as UBS fare around that. As you know, we have been very committed to the Asian market in general. We've been there for the last 60 years. Asia is a fast-growing region, always has its a bit of an ups and downs, but over the cycle it grows much faster than many other regions. And we know that in fast-growing economies, so now and then you will have disbalances for which new policies will have to be introduced to correct some of that. And I think that's what the Chinese policy for common prosperity is bringing. Basically, what they're trying to do is making sure that the buildup of wealth in China moves from a pyramid to more like an oval, so that the wealth is more evenly distributed. Now, a change from one policy to the other can always lead to short-term disruptions or adjustments, let me put it that way, some of which we have seen. It doesn't make us less strategic around what we want to do in China. Actually, we actually feel that that the move to common prosperity in the way the wealth will be built up will actually be good for us as well. We have a wealth management approach there. We have an asset management approach there, and we are a very strong player in the investment banks, both on onshore and offshore. And we think that the combination of the three will continue to make us successful in China. So clearly there will always be some, as I said, some short-term adjustments with policies changing, but that is not that we see everywhere in the world, right? So and that is something we'll have to deal with ourselves as to how we go about our own plans. And clearly, our CIO, who basically delivers the investment advice, will take that into account as well.
Thank you.
The next question is from Brenna Hughes from Reuters. Please go ahead. Ms. Hughes, your line is open. Ms. Hughes, we can't hear you. Maybe your line is on mute?
Hi. Sorry, can you hear me now?
Yes, we can.
Hi. Okay. Apologies if this is repeating anything from before, but I missed a few minutes. I wanted to ask about the U.S. rollout and whether you already have any figures on how much you plan to be investing into especially the rollout for affluent clients next year. And then furthermore on the various tech initiatives that you've previewed, whether those are going to fall within the budget of what you've previously advised regarding 1 billion in gross cost saves by 2023 and the reinvestment. And then finally, on China and Asia more broadly, I know you mentioned that you are planning to continue investing in hiring, but I'm wondering if we could get any more granularity on your hiring plans at the moment and whether you see a ramp up or possibly slowing from previous plans given the current environment. Thanks.
Okay. Yeah, thank you, Brenna. So I will work my way back up to your first question. So I'll start with Asia and China. Now, actually, we think that so the core of the analysis as to our strategy is being, so where are the largest wealth pools and where do we expect wealth to grow fastest? Because that's so our ecosystem of asset management capabilities, investment capabilities, and wealth capabilities are geared towards supporting our clients to build up their wealth. And you know, in my previous updates, I've indicated to you that the wealth pool in the U.S. is the largest and will continue to grow faster in the world on the back of entrepreneurial wealth. And in Asia is second largest, will also continue to grow faster in the world, and also generally growing through entrepreneurial wealth. And therefore, you know, the way what we offer there, both in the U.S. as well as in Asia, is we actually go after those clients that represent those future wealth pockets, whether it is in the technology in technology, for example, and cater for them, and adding therefore also advisors in order to support these clients. So we don't think that maybe a short-term adjustment leads to a review of strategy. On the contrary, as I said before, I think our strategy is just confirmed for China, but also for Asia. So it's one where we will continue to invest in people on the ground, invest in knowledge and making sure that we have the right approach as well in China, in Asia. So it's and the granularity is literally to the number of FTEs, and we don't give that, Brenna. But what is important for you to know is that we focus on Asia and China there as well. Then your second question around, you know, our plans in technology. This is about, you know, how do we move away from legacy technology to new technology? How do we move to the cloud? This is about how do we get better engineers and how do we develop an engineering culture? Then how do we actually invest in technology and work agile in order to make sure that we do incremental investments rather than big bang investments that sometimes don't pay off or you have to write off. So what we're doing on the technology side is making sure that we are much more effective with the same budget so that we get more bang for the buck. so to say, and that we deliver faster. And those two components, I think, as we can improve within the way we manage, and therefore we don't necessarily have to increase the technology budget beyond where we are currently, at least not to a large extent. We have to, and to the extent we need to invest going forward in this initiative or any other investment initiative, indeed, that will be largely funded from the 1 billion saves that we have announced in April, and that will come to fruition to a large extent in 22 and 23. Then on the US side, there is just no more details to be given, other than that we feel that our 2 million workplace wealth clients that currently have their retirement plan with their pension plan with us, or their stock plan with us, that we feel that it is good for us to offer them a digital wealth offer beyond this, or instead of this, the moment they basically will actually cash on their stocks and make sure that they find a place to manage their wealth going forward as well. And that's why we're developing this offering. There is no further details at this moment that we want to give.
Thank you.
We will now take the last question from Marion Alstermeyer from Bloomberg News. Please go ahead.
Hi, Ralph, Kurt. Thank you. I know it's getting late in the day, and I almost didn't make the cut, so I'm appreciative of it. Just a question on my side again on the U.S. Digital Bank. In order to create this sort of division, where are you pulling the talent from? Are you going to be hiring a certain selection of people, or are you moving some people from your brokerage business, or how is that going to work?
It's a mix of the three. Clearly, if we do a play like that, we want to do it the UBS way, in terms of that it has to be representative of our superior content that we develop, and that we are known for, and that clients really like us for. But also the experience that we have built up over the last couple of years in building remote advice in the U.S. already, supporting our financial advisors. And basically, those two experiences are a starting point there, so we can actually work from there. And then on top of that, clearly, for the digital offering and developing such an offering, we would have to attract additional talent as well.
Do you already have an idea of how many people you need, or is that something you'll give us more details on later?
But we're not disclosing it, Marianne.
No worries. All right, thank you.
Thank you.
I will now hand over to Masha Askins.
Thank you, operator, and thank you all for joining us. If you have any further questions or follow-up, please reach out to your communications and media contacts, either here in Switzerland or in your local area. Appreciate you being with us. Thank you.
Ladies and gentlemen, the media Q&A session is over. You may now disconnect your lines. Goodbye.